You've done the hard part. You've saved $100,000. Now comes the decision that matters even more, making it work for you. You have two great options. On one side, IVV gives you a slice of America's biggest companies. On the other hand, SCHD pays you real cash with steady, growing dividends. Both are trusted, but they couldn't be more different in how they build your wealth. In this video, I'm going to break down the differences between IVV and SCHD. Which one grows your portfolio faster? I'll break down their performance, compare their strategies, and help you and John decide which ETF might be the better choice for your $100,000 investment. In the end, I'll show you the side-by-side projection of both ETFs and see which one can reach over $3 million and which one could pay around $30,000 in monthly dividend income. But first, let's start by understanding exactly what these two ETFs are designed to do. IVV, officially called the iShares Core S&P 500 ETF, is designed to do one thing really well: give you a slice of the biggest, strongest companies in the U.S. economy. If you've heard of it, it's probably in IVV. IVV doesn't bother picking favorites either. It simply mirrors the S&P 500 index, meaning you automatically own a tiny piece of the 500 largest public companies. Think of it like buying the whole field instead of betting on a single horse. If the U.S. economy grows, IVV grows with it. Now, IVV isn't flashy. It doesn't aim for crazy short-term gains. Instead, it plays the long game. Companies inside are usually mature, stable, and still finding ways to get bigger every year. Over time, the idea is simple. The U.S. economy as a whole tends to move upward, and by riding that wave, your money does too. It's like getting on a slow but powerful escalator that gradually takes you higher. SCHD, on the other hand, took a different approach when Schwab launched it back in 2011. Instead of chasing the entire market, SCHD zooms in on companies that not only make money but share it consistently with their investors through dividends. Companies inside SCHD have to meet pretty tough standards: strong financials, a history of paying and growing dividends, and business models that aren't easily shaken by market chaos. But knowing the strategies of these two ETFs isn't enough. What really gives these funds their strength is the companies they hold. And once you peek inside their portfolios, you start to see some very interesting differences. Starting with IVV, the idea is pretty simple. If it's big and important in the U.S. economy, it's probably inside this fund. Companies like Apple, Microsoft, and Nvidia take up major space. In fact, just those three alone make up almost 18% of IVV's entire portfolio. Add Amazon, Meta, and a few more tech giants, and you realize that while IVV is technically diversified, technology is pulling a lot of the weight. Sector-wise, technology makes up over 30% of IVV's portfolio, followed by financials and healthcare. Now flip over to SCHD and you get a very different picture. Only about 100 companies make the cut, and each one has a strong track record of paying dividends through thick and thin. You're looking at names like Coca-Cola, ConocoPhillips, Verizon, and Altria, companies that have been making money, sharing it with investors, and weathering every storm you can imagine. Sector concentration here is pretty interesting too. Consumer defensive stocks, companies that sell the stuff people need no matter what, make up a big chunk. Energy companies like ConocoPhillips and Chevron are major players too. And while SCHD does have some tech exposure, it's nowhere near as dominant as in IVV. So what does this mean for someone like John or for you? Well, with IVV, your fortunes are more tied to the broader economic cycles, and particularly the success of the tech sector. You're riding the ups and downs of innovation, consumer spending, and market trends. Meanwhile, with SCHD, you're leaning into reliability. Everyday essentials, utilities, products people keep buying even during recessions. It's a more grounded, cash flow-driven approach, built for those who like the idea of steady income even when markets get rocky. In the end, I'll show you the side-by-side projection of both ETFs and see which one can reach over $3 million and which one could pay around $30,000 in monthly dividend income. Okay, so understanding what's inside these funds is huge, but knowing what's inside is just part of the story. Because it's one thing to own great companies, it's another thing entirely to watch how they behave when times get tough. Starting with the most recent numbers, 2025 hasn't been kind to either fund. IVV is down about 6.7% year-to-date, while SCHD is down 5.89%. At first glance, it might feel disappointing, but when you dig a little deeper, it makes sense. The overall stock market has been facing pressure from rising interest rates, inflation concerns, tariff wars, and tighter monetary policies. Big tech stocks, which make up a huge chunk of IVV, tend to feel the pinch more when interest rates rise, and that's been a major reason behind the drop. Even SCHD, which usually holds steadier, wasn't immune. Defensive sectors like consumer goods and energy took hits too, especially with fluctuating commodity prices and slowing consumer demand. But zoom out a little, and the bigger picture starts looking a lot more encouraging. Over the past 5 years, IVV has gained an impressive 93.46%. Despite the short-term bumps, that's nearly a doubling of value. Tech giants like Apple, Microsoft, and Nvidia drove a huge part of that growth, especially during the explosive post-pandemic bull market, when technology reshaped everything from how we work to how we shop. Meanwhile, SCHD delivered a strong 55.79% gain over the same 5-year period. It didn't skyrocket like IVV, but it provided a steadier, more predictable climb. Going even further back, the 10-year numbers tell an even stronger story. IVV posted a massive 158.92% gain over the past decade. There were corrections along the way, like the sharp pandemic crash in 2020, but every single time, the broader market bounced back stronger and IVV was right there riding the wave. SCHD also did very well over the decade, delivering a 92.54% gain. While it lagged behind IVV in pure percentage terms, it offered something else that's incredibly valuable: stability. For someone like John, who is thinking about building a 30-year future, understanding these behavior patterns matters just as much as knowing the numbers. Growth is great, but not if it keeps you up at night worrying about the next crash. Here's where things get interesting. If you're a dividend investor, you probably prefer the idea of getting paid without selling shares. If you're a growth investor, you might not care about dividends at all. You just want the highest possible return. But what if you could actually compare these two strategies side by side? What if you could see exactly how much money each ETF generates over the next 30 years? Well, we did the math, and the results might completely change how you think about investing. And that brings us to the next big question. What happens when we actually compare a $100,000 investment in both ETFs over 10, 20, and 30 years? Let's run the numbers and see which one comes out on top. Starting with $100,000 invested today and no additional contributions along the way. Historically, IVV's share price has grown by about 9.97% annually, and it offers a dividend yield averaging around 1.26%. Not huge for income, but not nothing either. And importantly, IVV's dividends have been growing too, at an average pace of about 6.95% a year. Based on these metrics, after just 1 year, John's $100,000 would grow to about $111,230. Fast forward to year 10, and the portfolio would reach $285,784. By year 20, it would be valued at $795,582. And at the 30-year mark, John's $100,000 will reach an impressive $2,172,344, paying an annual dividend income of about $10,180. The total value added to John's investment will be about $2,072,344 over the original $100,000. Of that, $1,940,920 comes purely from the share price climbing higher, while $131,424 came from reinvested dividends. Now let's compare that to SCHD, the Schwab U.S. Dividend Equity ETF. Right now, it sports an average dividend yield of around 3%, which is already more than double IVV's. Even better, SCHD's dividends don't just sit still. They've been growing at an impressive 11.3% per year. And to top it off, it also has an average share price appreciation of 6.78%. Based on these metrics, in the first year, John's portfolio would nudge up to around $109,780. After 10 years, the portfolio would grow to about $270,645. At the 20-year mark, the portfolio would be valued at about $880,351. And at the 30-year mark, John's $100,000 investment in SCHD would balloon into a massive $3,786,809. And here's the jaw-dropper. The dividend income alone would be paying John about $348,177 every single year. That breaks down to roughly $29,015 per month. Looking at the breakdown, the total value added from SCHD over the original investment is about $3,686,809. Out of that, about $1,651,298 came purely from share price appreciation, and a solid $2,035,510 came from dividend reinvestments compounding over time. This paints a completely different picture than IVV, doesn't it? After 30 years, $100,000 in IVV would grow to about $2.17 million, paying around $10,180 a year in dividends. Solid growth, but modest income. Meanwhile, $100,000 in SCHD would reach nearly $3.79 million, outperforming IVV by more than $1.6 million. Even more impressive, SCHD would generate around $348,000 in annual dividends compared to IVV's $10,000, a 34 times difference in cash flow. Want to know how to turn $100,000 into a $10 million portfolio? Click the video on the screen to find out.